Have you ever wondered why price hits your stop loss like this particular example over here? When price will take you out before going to your direction. Well, that is called liquidity sweep, and the smart traders use this particular scenario to their advantage. So in this video today, I'll be teaching you guys everything you need to know about liquidity. Now, what is liquidity? Liquidity is where money sits in the market, as simple as that. The banks and institutions, they hunt for liquidity to be able to fill their massive order. You understand? So this liquidity is hidden above equal highs, below equal lows, at trend lines break, supply and demand zone, support and resistance, anywhere. Liquidity is being hidden at any particular place in the market. Now, I'll be using an illustration to show you what I mean. Now, for example, this is our supply zone over here, and this is our demand zone over here. Our support and our resistance, Now, if price should come to this particular area, what are you expected to do? You're expected to sell down to this particular place, putting your stop loss above here, above this particular area here. This is what you're expected to do. But liquidity in the market resides where your stop loss is. So anything above this particular place is liquidity. Anything above this particular place is liquidity. I know what price will do. The smart traders, they will manipulate the market to cause what we call a fake breakout. This is your entry, a little down for you to be in small profit, and before you know it, price will take you out and do what? And start going to your direction. This is what we call liquidity sweep. They use your stop loss to fill in their order. So now I'm going to I'm going to be showing you guys so many types of liquidity that we have. Let's take this away. Types of liquidity. Now, first of all, we have internal liquidity. This particular liquidity is found inside the range. You understand? Or you can see this particular liquidity in a consolidating market or a range market, whereby market will be moving from up to down without breaking any lows, just be doing like this. Now, where does liquidity reside in this particular area? Liquidity resides above here and below here. This is the particular place where liquidity resides in this particular scenario. This is what called internal liquidity. You understand? So this particular liquidity is often used to trap early traders, for you guys to start stacking your sell position in this particular area here. Before you know it, price will do what? Price will from this particular place and take you out before continuing the particular trend. You understand that now? So now our second, we have external liquidity. This particular liquidity is found outside the range, maybe a previous day high, a previous day low. Now, for example, we have something. If we have something like this is a candlestick, a day candlestick. Now, liquidity resides above this previous day high and also above this previous day low. I know price seek for liquidity before moving, and below this previous day low. This is where liquidity resides. This is what we call an external liquidity. And we also have inducement zone. Understand? A setup created to trick retail trader to enter early, something like this. This is what we call inducement. This is your particular chart. Something like this, and you are expecting price breaking structure to the upside. You are expecting price to come down to this particular place, but price stops at this particular place, start going up, and then you start stacking in your buy position from here. You enter your buy position from here, and price did what? This to the upside and take you out full time before going to your expected place. That is what we call inducement sweep, where price will take everything out, both your entry and your stop loss, everything will be out. You understand? So this particular scenario is common around order blocks or fair value gap, whereby you need order blocks for your confirmation. Yes, seeing an order block and also seeing a fair value gap is a very solid confirmation, but price might use it as inducement and take you out. You understand? So now, how do the market makers use inducements? I'm going to teach you everything. Please watch this video to the end for you to be able to understand You understand how the market makers use it? Now, first of all, they create first breakouts to grab liquidity. If this is your entry, price has been ranging. Now they will create something like a first breakout for those entering their sell position here. This first breakout is what we call liquidity sweep. Price has sweep out all the liquidity residing below this 2-man over here before doing what? Going down. This is how the market makers use liquidity. You understand? That's why price doesn't move randomly. Price is just going to where there is liquidity. Anywhere there's liquidity, that's where price is going. And that particular place, I think price is going to get it. And once there's liquidity in the market, there's movement in that particular market. Now, the next, I'm going to teach you again how to trade with liquidity. Trading with liquidity can be very hard, but if you watch this video again to the end and you do not miss any part, you will learn how to trade with liquidity. So first of all, you know our strategy. Let me use an illustration to explain our strategy. Our strategy, we are trading SMC, whereby we need, I think, at least 5 points before we can be able to enter a particular trade. Now, this is our market early morning, as early as 9 o'clock in the morning, and price has been moving up, breaking structure to the downside, and all we need to do is wait for price to do what? To return to this other block over here. This is our other block over here. And for our other block to be valid, we need what we call our fair value gap, also known as inducement. So this is our fair value gap over here. Now what we need for price is to do what? To retrace down to this particular other block and give us our entry to the upside. That's all we want from price to do. But before price reaching that particular place, price is going to create what we know as liquidity. We need a liquidity, because without liquidity, this particular place will be the liquidity. Now, when looking at this particular place, we have liquidity residing below this other block. This is what we call external range. Liquidity rests below this particular place. If we should enter this particular market without even from this other block, price, do you know what price will do? Let me show you what price will do. Price will do like this. From here down without any liquidity form. Price will just take us out. We are the liquidity. Price will take us out and do what? And continue going out, because we are the liquidity. We do not wait for liquidity, we are the liquidity. So, but for us to have a very perfect entry in this particular place, we need price. We need price to do something like this. Move down to the downside, create what we call liquidity. Now, liquidity resides below this particular area. Then price will need to sweep that liquidity to the downside, tap us in before dishing out our take profits. As easy as that. Okay, guys, now enough of this illustration. Let's dive into the market example. Let's see if we can see any example before we trade. Now, watch this particular scenario over here. This is our break of structure, and this is our other block here. We want to trade from this particular other block, from this particular place. This is where we want to start stacking our sell position. But assuming price do not create this particular liquidity over here, this is all called liquidity. This is liquidity sweep. This is a liquidity here. Assuming price do not create what we call this particular liquidity over here, we are going to be the liquidity, because price will need to sweep us out from here. Price will need to sweep us out, grab this liquidity residing above here before doing what? Dishing down to the downside. But because of this particular liquidity being created over here, price was able to smoothly dish out our profits. You understand? So you can see what price did. Price created liquidity over here, moved to the downside, and sweep that liquidity before diving into our other block with a fair value gap inside this other block here. This is our fair value gap over here. This is a fair value gap here. From here down here is a fair value gap. So before price was able to dive into our other block, and our stop loss should be below here, and our take profit should be this particular fair value gap over here, and price was able to dish out to our TP as easy as that. So first of all, we have our break of structure over here. This is the break of structure, and this is our other block over here, the other block that causes, or the origin that causes the break of structure. Now we cannot just start entering this trade once price reach our other block. No, we need a confirmation, something like liquidity. Price must create liquidity for us to be able to know that this other block is valid, a liquidity. Now this is the liquidity over here. Now from here to here, this is a liquidity. So many people start stacking their sell position from this particular place, but you will get stopped out by the market. You understand? So this is the liquidity, and this is a fair value gap over here itself. So this is a very correct trade. So anytime you are trading, look out for liquidity, because liquidity helps a lot in the market. Liquidity helps a lot in the market anytime you are trading. So, and down to this particular man over here, this liquidity over here, this fair value gap over here, and you're out of the market. As simple as that.